Welcome back. You're watching Your World at 10. Now, the Direct Taxes Code Bill was tabled in Parliament today, as we told you earlier. It's more than 400 pages, so let me quickly give you just the key headlines. The corporate tax rate has been proposed at 30%. Profit-linked exemptions for SEZs will be grandfathered. The long-term capital gains exemption on listed equities stays along with STT. Short-term capital gains would be taxed at half-year slab rate. That's at 5, 10 or 15% depending on which slab you are. As far as individual taxation goes, the exemption limit has been hiked to 2 lakh rupees and a wealth tax of 1% on assets more than 1 crore rupees will be levied. Now, the new direct taxes code is expected to be applicable 1st April 2012. At the end of what seemed to be a 3-year, very long exercise, what kind of new law are we faced with? Well, joining me to talk about that is Dinesh Kanabar, Deputy CEO and Chairman Tax at KPMG. Mr. Kanabar, before we actually discuss where we've ended up with this new bill, let me ask you for some quick impact analysis. Any materially different impact on both companies as well as individuals as compared to where we are today under the existing Income Tax Act? It doesn't seem to me like life will change much, will it?
I don't think there's a dramatic change in the corporate sector. We have certain things like foreign companies being regarded as resident in India if their place of effective management is in India. We have this whole change on overseas transfers with an underlying value in India, which again is a sea change. There's an introduction of controlled foreign company regulations. And finally, of course, we have the general anti-avoidance regulations or the GAR.
Right.
So which, if I would say, are the 4 or 5 big changes really in the way we have approached taxes hitherto. But certainly a sea change from where the position was in terms of the first draft, what was there in the second discussion draft, and what has finally emerged as the position with the government is taking in terms of presenting the bill. So a very, very shifting of stand. And at one level you could come back and say that have the lobbying groups really got their pound of flesh? Another way you can come back and say, is the government really listening to people and doing things? And if I may again give you a perspective that probably about 4 or 5 years back the government embarked on a mission to say that can we rewrite and simplify the law. Actually a committee was set up to review the tax laws. That was given a go by, and then a whole new law was sought to be enacted with MAT on gross assets, etc., etc., etc. And we now seem to have come back to the original position. Just simplify the law, keep it as it is. Don't change the overall framework, do away with all the exemptions, do away with all the provisos, explanations, etc., and have a law which people can simply understand.
So we've just ended up with, if I was to paraphrase what you just said, a simpler version of the existing Income Tax Act after 2 years of heated debate on a new direct tax code.
I would agree with that. But is simplification itself not a very good objective to have really? So
But it didn't require 2 years of debate then.
I agree with you. I totally agree with you. But that is the 2 years of debate came from a position where the government moved from just one objective of simplification to a lowering of a tax base. So the position was, can we get a tax rate lower to 25? If you wanted to get tax rate lower down to 25%, then you had to do something else to balance and raise resources. And you wanted to then have assets based MAT taxation, etc., etc. Yeah. So when you remove that objective, everything changed really. So it was really shifting of the government's objective and focus in the interregnum which led to this whole changes.
Mr. Kanabar, I appreciate simplicity. I also appreciate the fact or the point that you made that all the efforts made by the tax department and the finance ministry to actually usher in a whole new regime of taxation where you've lowered the tax, sort of taxability on individuals and then brought 3.5 lakh companies, as Arvind Modi used to say, into the tax net by imposing a MAT on assets, doing away with the capital gains exemptions and all of that, so as to be revenue neutral. You've not been able to do that because various interest groups have lobbied away various aspects, right? India Inc. lobbied very hard against MAT on assets. Rightly, wrongly, whatever, they lobbied. The market sector lobbied very hard against any change on capital gains. And so at the end of the day, we were not able to accomplish much. We should have been able to accomplish more.
So at a different forum, you asked this question to a group of us, including me, as to whether this is a new tax code for the new generation or
is this for the new economy?
Do you really, and I really don't know whether you need a new tax code for a new economy, Menka, and I'm being very honest about it.
Okay, sure.
Really, it was a question where the government wanted to make a statement that we are competitive in the marketplace and we are getting the tax rate down from 35% almost to 25%. We have now come back to say lowering of rate of tax to 30% is good enough so long as we have simplified. So I would like to believe that you did not have to go through this entire jamboree or circus over the last 2 years. But effectively what we have been able to achieve is this one goal of saying, can we have a tax rate which is simple? And just going back to this issue about wanting to tax companies which are not hitherto in the tax net, and the question was, either your compliance mechanism is not right, in which case if these companies are making profits, you have not been able to catch them, or if these companies are not making profits because they've got exempt income, then do you really want to tax assets? Is that what you want to do under the Income Tax Act? Is something which government needs to answer.
Simplicity was one goal of a new code. The other one was to be able to bring more non-tax paying entities into the tax net. Does this bill go any length in being able to achieve that?
A couple of things. I wouldn't say it goes the whole hog, but there are a couple of things which have happened. So for example, when you look at controlled foreign companies, you're looking at forein companies where you are able to park as in dividend income and not get it into India. You have now been able to bring it into India. Very interesting. One of the things which has happened, and I must admit that I haven't had an occasion to study these provisions, the Settlement Commission was actually being given a go-by. It has been revived under the new code. I have not really studied the contours of how it works. A couple of things which still continue to be disappointment. So one of the things was really that on capital gains we spoke about, that how are you distinguishing between capital gains on equity and on other assets? So really,
to simplify that for viewers, what you're saying is that there is a long-term capital gains exemption on equity. For short terms, it's at half your applicable rate of tax, so that's 5, 10 and 15%. But that's only for equity. All other assets, capital gains will be taxed at your marginal rate or your regular slab rate. Right?
So you have a very interesting situation. Take equity, which is a listed equity, held for a period of 6 months. But it's capital gains, it's not business income. You will end up paying tax on half the applicable rate. If it was an unlisted equity and you held it for 10 years and you sold it, you will pay a full rate of tax.
So there's a distortion in that.
So there is a distortion somewhere out there, and I'm unable to reconcile that distortion. Similarly, if you have made investments in other assets, real estate or whatever else, and even if you held it for a long-term basis, then you end up full rate of tax. There is no exemption at all. So why this preferred regime for equity which is listed on the stock exchange is something which I can't understand. And that's where probably I empathize with the point which you raised, that is it only where there are lobbying groups that you will get a particular...
because very honestly, CFC, GAR, the attempt to tax offshore transactions whereby at least half the asset represented is in Indian asset, all of these could have been introduced through various amendments to the existing IT Act.
Absolutely.
Really, we've not been able to take the rate for companies down to 25%. We're now at 30%, which is respectable enough. We haven't done much change to the individual tax slabs. So we could have done all of this through 3 or 4 amendments over a period of 1 or 2, 3 years, and we would not have spent all these hours debating this potential new DTC.
Except that, again, when you speak about broadening the tax base, the fact that you are doing away with all the exemptions, you are also doing with a lot of litigation surrounding that.
Replacing it with investment-based incentives,
no, but again,
right?
that again is only provided those investments have been made before, so it does not apply to new undertakings. The exemptions will apply only in respect of investments made and completed up to a particular date.
Okay.
So, in that sense, by doing away with that entire regime, you're doing with a lot of litigation.
So, we've done away with exemptions. That's the one big achievement of this 2-year exercise?
No, I'm not trying to justify the exercise at all, so let me not answer in that fashion.
Who gained from all of this, Mr. Kanabar? Except for media, because we got to discuss it ad nauseum, and consulting firms who got to, scare all their clients and say, hey, watch it, there's a whole new tax code coming by.
No, I don't think anybody... I think, really speaking, the government's objectives kept on shifting. As I said, if the objective was merely to simplify law, they should not have gone down this path that it did. Somewhere along the line, the objective was to bring a whole new tax regime, something which, as you would say, is futuristic. Whether it was indeed futuristic or not, I do not know. It got a significant pushback, and we now went down to a very simplistic objective of having a simplified tax law, probably expanding the base a little bit, and probably doing away with the exemptions. So in that sense, given the fact that the objectives kept on shifting, we went on debating ad nauseum from position which was X to Y to Z.
Okay, if you were to forget the first draft altogether, okay, and say that suppose we achieved the simplification that we needed to do in this draft and all the extra additions like GAR or the taking away of the exemptions, are we still in need of a visionary new tax law?
I do not know. I do not know whether we need a visionary tax law at all. I don't think any country really looks at a tax law which is visionary. You need an investment regime.
Are we going to restart this debate on a new tax law 3, 4, 5 years from now, saying, oh, well, we didn't achieve much in the first round, let's give it another try, let's say in 2014 and 2015?
So let's look at 2 separate things out here. the fact is that India is going global. That required a CFC. So in that sense, you have changed your tax law consistent with your regime. And then at another end of the spectrum, there are overseas transactions with underlying value in India, and you wanted to tax them. And therefore, you now brought out a new regime altogether to say that if there is a change of a shareholding overseas, where the underlying value in India is more than 50%, then that's liable to tax in India. Of course, the way they have gone about doing it is a bit peculiar, to say as if it was always the law, and you are now sort of carving out.
Well, they had to do that, right? Because otherwise they'll be giving Vodafone some ammunition.
Yeah, but leaving that aside, so what you have done is to recognize two things which are a changing aspect of our economy, that there will be increasingly global transactions, but with the predominant value underlying in India, you wanted to tax it, and you have brought out a regime, forgetting the peculiarities of how they have done it, but that is a change situation. And CFC, which is again a change situation, that India is itself becoming global. So to that extent, the law is looking at the changes within the economy.
And that's good enough.
And that's good enough.
We don't need a brand new law. And you promised me this debate will not start 5 years from now, Mr.
I can't promise you that. That probably is what a finance minister can promise you. But I have not heard really any regime go and talk about to say that our law is futuristic and visionary, save except to say we'll make it very, very competitive.
All right. Thank you very much, Dinesh Kanabar, for joining us. And with that, I need to wrap up this edition of Your World at 10.